Now we're going to have our final talk from Keith Hiscock, CEO of Hardman Co. As I said before, this is moving away from oil. Keith has been working in the city for something like 40 years. In the past, he's worked for James Capel, Horgavet, lots of names that were very famous and well respected in the past, even if some of them have disappeared now. He's been CEO at Hardman since 2012. Hardman are a broker for small and mid caps. They also do paid for research, so he really understands the small and mid-cap end of the market. And we're going to hear more about some new research that his firm have just done. So Keith, please tell us more.
Thank you very much. I think when we set this talk up, Donald and I didn't realise quite how timely what I'm going to talk about is, because on the way home you might want to pick up the Evening Standard, and the lead article in the Evening Standard by Anthony Hilton is entitled "Overzealous Watchdogs Have Put the Bite on Liquidity." So I'm going to be talking about share ownership, price discovery, liquidity and market makers. I'll explain a little bit about what Hardman does. Hardman is not a broker. I need to correct you on that. Hardman is, in many respects, very similar to Edison. So we're the largest, the two of us are the largest players by far in the sponsored research world. So we write research about quoted companies paid for by those companies and made available to every sort of investor through a series of mechanisms. We're also a leading research house in the tax enhanced space, so that's business relief, IHT, EIS. And then we have bespoke services where we use the skill sets of our analysts to help companies, stock exchanges, expert witness work for court cases, due diligence reports. There's some stock exchanges you want to list on, you have to get a DD report from us, the exchange, and various other uses. So, share ownership, price discovery, liquidity and market makers. What I'm going to talk about is, first of all, the difficulty of determining who owns what in the stock market. Then I'm going to tell you who owns the stock market. Then I'm going to talk about the change in that ownership over time, both for the rest of the world investors and retail investors, and you'll understand why when you see the numbers. I'm going to then talk about the retail investors' impact on prices, which I suspect is quite interesting for this audience. I'm going to talk about why anybody cares about liquidity. And then finally, Donald wants me to say a few words about market makers. So, what can we know about share ownership? Well, the first thing when you look at a share or a company is to work out where its domicile is, because the rules are very, very different. So if you're a UK domiciled company, your register has to be a public record. Anybody can turn up and ask the registrar to look through it, and there are some services, the one with whom we've done a lot of work recently called Argus Vickers, who have a whole team doing that all the time. If you're not a UK registered company, it's a bit different. So for example, if you're registered in Guernsey or Jersey, the data available is much more restricted. However, when I say that if you're a UK company, you can see who owns every share, you can, but most of the shares are owned by nominees. Now, if you're private investors here, almost certainly very few of you own shares directly in your own name, because it's really difficult to deal through Crest. If that's what you've got, you'll own it through your broker's nominees. And that's true of most shareholdings in the market. However, there is some help provided by announcements. So if you look through the RNSs that come through every day, you'll see there are certain situations where the beneficial owner has to declare his interest. It may be in a nominee, but he has to declare it. So for example, in a takeover situation, the rules, Rule 8, requires you to disclose, if you're dealing in stocks, who the beneficial owner is. There's no good just giving the nominee name. Now obviously, in putting all of those RNSs together, you can build up a database of who is behind each nominee account. And there are services like Argus Vickers that take all of that data and then apply it across the market to try and understand who owns the market. There are good and bad reasons for using nominees, and we can talk about that later if you want. So you can create a database from these Rule 8 announcements and work out who owns it. So here it is. So this is our work with Argus Vickers. So this is, you won't be able to read this probably at the back of the room, so I'll describe some of the important elements. So this is who owns the market on the last day of June 2019. And it's split by different parts of the market. So if you look at the whole market and you exclude the NEX market, so I'm looking at the whole of the London Stock Exchange market, 64% of the market is owned by the rest of the world investors. Of FTSE, it's a bit higher, it's 69.6%. Of the main market, so that's excluding FTSE, it's 48.9%, and then it falls away quite rapidly. So the rest of the world owns 36.9% of AIM. Still a large number, but it's a lot less than it is of the market as a whole. And on the NEX market, it's only 7.6%. If you do the same exercise for individuals, you find a really different pattern. So you'll find that individuals own 8.3% of the London stock market as a whole. They own 5.3% of FTSE, but as you go down, you find that figure rises dramatically. So AIM, 27% is owned by the retail investor or an individual investor, and on NEX, it's 52%. So that's a snapshot of the picture of today, and there are all the other categories down there you can look at in your leisure. But now it gets a bit more interesting. The rest of the world shareholdings over time. So the rest of the world investor is the largest holder of large parts of the market. But how has that changed? Well, that's really quite a recent phenomenon. You won't be able to read the detail here, but I can tell you back in 1963, when the ONS first started their work, rest of the world investors owned 7% of the market. There were a few what you might call ex-colonial stocks, like plantations, where the rest of the world investor was quite important, but the market overall, they were not important. Only 7% against well over 50% today. In fact, the 7% fell in the subsequent years until 1981. In 1981, the rest of the world investor owned only 3.6% of the market. So what's happened to transform them to being the biggest investor in the market? Well, several things. So the shape of the market has changed. So London has become the international stock market. It is the place to list, unless you're an American generally, if you're looking for overseas investors. So when apartheid came along, all of the big South African companies decided they wanted to move their listing to London because the biggest pool of international investors was in London. So part of the change in the rest of the world is the shape of the UK stock market has changed. In a way, it's not a UK stock market, it's an international stock market, and that's brought overseas investors. You've also seen, obviously, a change in the institutional shape, and so a number of UK investment managers become part of international groups. If you now look at the retail investor, the story is sort of the reverse. So back in dear old 1963, the UK investor owned more than half the London stock market. It's actually 54%. And it has consistently fallen since then. Why is that? I think it's consistently fallen because the UK investor has been driven by marketing, by regulatory regime, by a change in the shape of products and offer, into collective products, into open-ended investment companies or unit trusts, that sort of thing, and increasingly has held his interest in the market through those rather than through individual shares. This figure, though, bottomed out in 2008 when the retail investor owned 10.2% in the market. Since then, there has been a consistent increase. The latest figures using this series is 13.5%. And what's behind that? Well, I think several things are behind that. I think, first of all, I'd like to think investing has become a bit easier. There's a lot more information available over the internet about companies than there was. I recognise entirely that it's still not a level playing field with institutional investors, but I think it has become a bit easier. I think investors are paying more attention and more interest in direct investment. So, for example, the introduction of SIPs for pension funds has allowed people to manage their own money, and they've started to by individual shares. So I think there's a change going on, and I think it's likely to continue. And so you can argue that the retail investor is becoming more important in the market. Obviously, he's extremely important on AIM, is extremely important at the small cap end of the main market, and he's also very important on NEX. But actually, these figures hide the impact of the retail investor on the market. So if you look at the trade sizes on the market, this is a very interesting story. So what I've taken here is a snapshot. Both of these snapshots are in November 2019. So the one at the top is of the AIM market. So let's deal with that first. So if you took every company on the market and ranked it by the average trade size, and then looked at what baskets they fall into, what you will find is approximately 83% of AIM-listed companies have an average trade size of less than £10,000. Now, we can't know who's on the other side of it. We can't say, well, that's definitely a retail investor, but I don't think it's an outrageous hypothesis to suggest that the smaller this figure, the more important the retail investor is to it. And you might say, well, so that's November 19. How realistic is that? You know, is that an unusual month? Well, we've done this exercise over many years, and the number's always between 83 and 85%. The table below does exactly the same thing, but for the LSE main market. Now, you might say that's going to be very different, isn't it? The answer is it is different, but it's nowhere near as different as you might think. So if you look at, again, companies who have an average trade size or bargain size of less than £10,000, they account for 75% of all the listed companies on the main market. Now, why is this important? This is important because I think for most companies, on most days of the year, it's the retail investor, the small trade, that sets the price. So we often have the managements of companies coming in to see us, and they say, I've kind of worked out what goes on here, which is that every so often there's a big trade. You know, there's an institution wants to take a stake or sell a stake, or the company wants to raise money. The other side of that trade is going to be an institutional investor or investors or professional investors for two reasons. They can deal in size and they can deal very quickly. But the price at which that trade takes place starts from the price in the days and the weeks before. It might be at a discount to that price, it might be at a premium. And that price has been set by lots of little trades. So they might think of it, companies or institutional brokers might think of it as the tail wagging the dog. But the reality is that for most days, for most companies, it's small trades that set the price. Now, I've used the term liquidity, which is another way of saying how many shares change hands, what percentage of the company change hands. There are various definitions around that. Why does it matter? Now, some people say it doesn't matter. Every share is always owned by somebody. Why does it matter who owns it? Well, I think if you were an investor in the Woodford Equity Income Fund, you would be concerned about it, because you've not been able to get your money out because many of the stocks in which the Woodford Fund has invested are illiquid. Many of them are private companies, obviously, and they're particularly illiquid. The FCA has been getting quite concerned about this and has been putting out some guidance about liquidity. It's not a great deal of help because it doesn't tell you what you've got to do as a fund manager, but it says, look, you need to pay attention to liquidity if you're going to provide, for example, daily pricing for investors. So most institutions now are worrying about liquidity in their underlying holdings. They're worrying because they've got the FCA leaning on them, they've got their own compliance departments leaning on them, they've got investors in their funds leaning on them. And so increasingly they are using a filter. So, they've always used a filter, depending upon what your mandate is. If you're an income fund, then you want a minimum income of X. There'll be some other financial criteria around that. So if you're an income fund, you might say, I need a free cash flow cover of the dividend yield of Y. But increasingly now, you've got a liquidity filter. You want to be sure that if you are investing money in a stock, that you can get out of that holding should you need to. Should there be redemptions of your fund if you're a unit trust, for example. I talked to one fund manager a couple of weeks ago who said, I've gone through that exercise and I've worked out that if I look back over time, and I can only look back over time at the liquidity in the stock, one of my holdings will take me 93 years to get out of. So it is important, and I say to companies that if you ignore liquidity, you run the risk of dropping out of the market. Institutions won't be able to buy you. Your share price will come under downward pressure. You'll find it more difficult to raise money. And frankly, there's no point being a quoted company. I mean, a stock market is a market, and a market only exists if there's liquidity. If things happen, that's what a market is. So briefly, how can a company improve its liquidity if you agree that it's something that one should worry about? Well, there are lots of things you can do, and here are some suggestions. So the first thing is, I always encourage companies to be much more open and transparent about their results and who can get to see stuff. So I have the privilege, I think it is a privilege, of being able to attend results meetings by companies. So this is where a bunch of analysts get invited along to discuss a set of results from a quoted company. At those meetings, there is a discussion, there is a presentation pack. I always say to companies, I see absolutely no reason why you shouldn't, the moment you start that meeting, post that presentation pack on your website so that all of your investors can see that. I see no reason why you can't record the meeting, because obviously, the chief executive talks to the slides and there's a bit of extra flavour. And you should be treating all investors equally. That's what the corporate governance guides say. If you're saying something to the slides in addition, which only the institutional broking audience can see, that's not being fair. I don't see any reason really why there can't be an audio or a video of the whole thing, including the questions. So I always encourage companies to do that, and I think the more transparent you can be as a company, the more you can engage with investors, the more likely they are to invest in you. The second thing is hosting capital markets days. This has become a bit more popular. This is where you get the chance to hear not just the chief executive and the CFO, but ideally you get to hear people running divisions or people interfacing with the customers of the business or the supply chain. Give you much more of an idea, because I think for most investors outside the professional sphere, often the only chance you get to meet the management and ask questions is the AGM, which is a generally rather dull affair and a formulaic affair. So we'd always recommend Capital Markets Day. Of course, I'm going to say employer-sponsored research house, and you've got a choice of two here, because both of our company's research is available to every sort of investor, and it meets a series of quality thresholds. I mean, we both employ people who have got long histories in as institutional analysts, for example. I'd encourage companies to attend retail events. So there's a number of shows that take place, and you've probably been to more of them than I have. Mello, UK Investor, those sorts of things are another way of engaging with a broader audience. Yeah, fine. No, I'll be there. Obviously, using the likes of LSE is another way of getting to a wider audience. Understanding your share register. So, if I were a company, I'd be looking at who owns companies that are similar to mine, and asking myself, well, why don't they own mine? And then possibly the most controversial is including retail in fundraising. and I'll come on and talk about that a little bit more in what I'm going to say about market makers. Now, the LSE has actually got a bit of an initiative around here, so they've just struck a deal with Primary Bid to try and engage more with retail investors when there are fundraising. So there are some really quite positive steps taking place there. So apart from the summary slide, this is the last slide. So Donna wanted me to talk about market makers. I'll show my age because I used to call them jobbers. Before 1986, before Big Bang, they were called jobbers. These were separate businesses. You were not allowed to be both a broker and a market maker, as we call it today. That was banned. You had to be single capacity as a business. You had to decide, am I going to make markets and be a jobber, or am I going to be a broker? That all went, and what we called jobbers became market makers. So these are parts of business, investment banks, the small cap brokers, etc., whose job is to make money as a market maker. Now, there's nothing wrong with that at all. There are sort of two broad sorts of it, and the phrase is used a bit too widely. The first is where you're actually putting your own capital up to make money, and the other is where you're just facilitating trade. Now, if you're talking about a FTSE stock, billions of shares, billions of pounds worth of shares change hands every month, and it's pretty easy to build a position and get out of that position. And the idea is to take a small turn out in the middle. It's also, not only is it liquid, but if you, for example, took the view that the market's going to collapse, you think, well, I might not be able to get out in my book, but I could buy an ETF, I could go short of something, or I could buy a future to go short of the FTSE. That's possible in those sorts of stocks. As you move down from those stocks, that becomes more and more difficult. You end up taking a position overnight using your capital. Now, the amount of capital that's committed to market making has shrunk dramatically over the last few years. It's been a difficult business. But the other thing that market makers do is to facilitate trade. So there are some stocks where there's one or maybe two market makers, and largely it's not really about putting a lot of capital at risk, it's facilitating. Ideally they'd like to cross stock and not have a position, but sometimes they need to have a position. You'll find very clearly that the lower the liquidity in a stock, the wider the difference is between the bid and the offer, if you've got level one, for example. So that's the role of market makers. It's to try and provide some fluidity and liquidity in the marketplace. But I think the area that's probably most interesting and controversial is around fundraisings. So there will be some commentators who say, if you look in particular AIM, so you know on AIM there's not necessarily a preemption right. So if you're a shareholder in a company, let's say you own 5% of the company, if you're on the main market, if the company raises new money, unless it gets approval from an extraordinary general meeting, it has to offer you 5%. Those rules don't necessarily apply for stocks on AIM. Right? And I think where people find this tricky is you come in the morning, the company's decided to raise a reasonable sum of money, issued quite a lot of shares. It's issued it at a big discount to the existing share price, and you as a shareholder in it aren't offered any. It's been placed with a few institutions, and that's where I think people feel uncomfortable. Now, I'll explain the reasons for it in a minute, but people feel uncomfortable about that because you've not had the chance. You've not been treated as in the same way as an institution might have been treated, and inevitably that leads to some suspicion that there's been some manipulation of the share price. Obviously, you'd be particularly concerned if the share price went back to where it was, a day or two after the replacing had taken place at half the price that it was before. I think the reason that happens is that the LSE in particular wants to make it easier for smaller companies to raise money, and if you have to involve everybody, the way in particular some of the rules around prospectus works, there's quite a lot of legal cost involved, and it takes a lot more time, whereas you could do a placing on AIM, raise a bunch of money overnight effectively. So that's why they do it now. Obviously the LSE with, as I just said earlier on, with primary bid, are trying to encourage retail investors to get involved, but I think that's probably the most controversial area. So I've talked about how difficult it is to determine who owns what in the market. I've shown you who owns the stock market today. I've shown you that the rest of the world investor has become dramatically more important than they were before 1986. I've shown that the retail investors became dramatically less important in the market, but has since recovered. I've argued that the retail investor has a bigger impact on share prices than their ownership of the market would suggest. I've explained why I think liquidity matters in the market, the sorts of things you can do about it, and finally I've said a few words about market makers.
Thank you very much, Keith. Fascinating stuff. Any questions for Keith?
Retail investors, I've only become aware of this business about liquidity literally in the last few weeks, and I've read the article you're referring to in the Standard, and I'm really saying what you have done here is to analyze, if you like, the issues that arise from the lack of liquidity and the place of the retail investor in that arena. And what I would like to ask you, ask Hardman and maybe LSE as well, really, to turn yourself into a campaigner to actually help the retail investor, gain a foothold on an equal basis with the rest of the institutional investor, etc. So that, because, this business of nominee account is really a disenfranchisement of the retail investor. But, for instance, I don't know, you probably have heard of ShareSoc, one of the, they are campaigning for this problem. And I want to just make a plea for, for this forum, to become aligned, if you like, with other organizations and help us,
Thank you.
as I said.
Keith, any thoughts on
Yeah,
that?
so obviously we make our research available to everybody. We encourage companies to engage with investors, all sorts of investors. We've done all that. I think your question in particular is pointed at the fact that effectively you're forced to own your shares through a nominee and you therefore cannot directly vote. And I agree with you entirely. I can't believe in this day and age that we can't have a system that enables the nominee to effectively hand back your vote for an AGM or for whatever. I agree with you entirely, and I know ShareSoc has campaigned about that, and I'd certainly support them on that.
Any more questions? Okay, well, just have a quick one from me then. On market makers, very interesting what you were saying around IPOs and placings and how there's suspicion there of what market makers do. But beyond that, often when I read discussion boards for private investors, there's wider skepticism about market makers. You sort of read, oh, well, market makers are moving the prices around purely to sort of diddle private investors and rip us off. Is there any fairness in those accusations?
I don't think that's true. Obviously they're there to make money. Of course they have to, because they've got capital at risk sometimes. I think it's simply the lack of liquidity. So, if you're, put yourself in the position of a market maker. If it's a stock where there's very little liquidity, you're the only market maker, somebody comes and sells you some stock, wants to sell you some stock, you probably mark the price down to get it, then you really want to get it off your book as soon as possible because you want to keep your capital as tight as possible. You could well end up marking it down, depends on market conditions, lots of other things. You could well end up marking it down until you find a level at which there is a buyer. So certainly for those stocks where the liquidity is poorer, you'll find that the share price is much more volatile. It's not because market makers want to do it, it's simply a reflection of the situation that faces them. And go back to what I said earlier. If you were market making in the FTSE, or even in the main market as a whole, you've got available to you a series of mechanisms to reduce your risk. So you can, if you think the market's going to go down as a whole, you can buy a put on the index. You can't do that in the small cap world. Those sorts of things. I mean, I've been in a situation at businesses where we made markets in lots of small cap stocks. We instruct the market maker, look, we think this market is going to take a bit of a tumble, the market as a whole. Can we make sure we stay off the bid in everything? I can tell you, as hard as you try, you cannot stay off the bid, and you end up accumulating stock, and you can't take a kind of future or derivative against it to guard against your risk. So I have a lot of sympathy for what they do, and it's partly related to the lack of liquidity.
Last chance for a question.
Okay, can I just jump in and ask you a question, Keith?
Yeah.
What made you do the research in the first place?
So I think there's a lack of understanding of the role of different sorts of investors in the market. The ONS, the Office for National Statistics, has done work in this space every 2 years back to 1963. That's where some of that data came from. I don't want to be critical of the ONS. It's owned by the government, and it's their job to find out what's going on. But what they do is they take a sample of 200 companies. Our work is based on every company, and they look at it every 2 years, whereas we've looked at it every half year. The survey they just published in January, the data they're using is from December 2018, so it's over a year old, whereas the data we've just used is from June 2019. So I think it's valuable to understand who owns the market. I think it's particularly valuable for you as investors to realise actually you're more important than perhaps you think you are. But if you combine the ownership of the market with these average trade sizes, you begin to realise actually you're a lot more important than many companies realise. I often, when we go and do a pitch to a company about our services, we always look at what the average trade size is. I've yet to come across one company in all I must have done hundreds of these. I've yet to come across one company who knows what that figure is. It comes as a complete surprise to them.
Do you find any resistance from those companies to deal with the retail investor?
There are some companies who openly say we don't really want retail investors. They're a bit of a pain. It costs us money to have them on the register. We've got to pay the registrar more for all of that, and they won't make any difference. We're not going to be able to raise a lot of money. So there are some companies like that. I think it's a rather short-sighted attitude because, as I've explained, they're pretty important to the generation of liquidity. If you want to engage with institutions and they've got a liquidity filter, you might fulfill every criteria that the institution wants to buy your shares. But now, if you fail the liquidity test, it doesn't make any difference. They're not going to buy you, and so the institution can't themselves overcome the liquidity test. They've set themselves. Somebody else has got to do it for them. Well, it's you guys.
Oh, we've got a question here.
Just one question on liquidity. So you mentioned about the average trade size. Does that take into account dark pools used by financial institutions? No,
the data I've used for that is simply the LSE reporting data and the NEX data.
And how do you think dark pools affect in terms of
market? So it varies depending...
Is it worth just quickly saying what a dark pool is?
A dark pool is another way of trading directly between institutions that doesn't touch the market. So we used to have a system where every trade had to be reported on the market. It was mandatory. But that's one of the things that changed with Big Bang as well. So dark pools are important at the bigger end of the market, in FTSE. As you come down, they're not really very important at all.
Okay. And thank you very much. Let's give a round of applause to all three of our speakers.